Today, FTX sues Sam Bankman-Fried and other former executives to recoup more than $1 billion. House Republicans introduce a new crypto oversight bill, and we explain why big banks are spending big money to put Wall Street on the blockchain. Welcome to CNBC's Crypto World. I'm Jordan Smith. Major crypto prices traded flat to end the week. As of noon Eastern, Bitcoin rose slightly, but still traded below the $30,000 level. Ether still traded just below the $1,900 mark, and Ripple's XRP token ended the week in the red. Bitcoin is on pace for its fourth consecutive weekly loss, and Ether is on pace for its second weekly loss in the past 3 weeks. XRP, however, is on pace for back-to-back weekly gains. So despite potential good news in recent weeks around regulation, what's holding back Bitcoin?
Bitcoin is following a similar pattern as it has multiple other times, where it has this really big bull market and goes to a super high price, like this time I think it was 69,000, then falls back to a little bit above the previous high price. So I think at some point we see another boom, the next bull cycle that starts. The other thing holding it back is I do think there is a lot of regulatory capture and anti-Bitcoin and crypto regulation that has come out of the current administration. You've seen what's happening with, regulators going after Coinbase and other big players in the space. So I think while it's not surprising, we definitely think at some point the tide is starting to change and will start to change even more.
Okay, let's talk about the top stories. FTX is suing Sam Bankman-Fried and other former executives, seeking to recover more than $1 billion they allegedly misappropriated before the crypto exchange filed for bankruptcy. The complaint filed yesterday also names Caroline Ellison, who led FTX's sister hedge fund Alameda Research, former FTX technology chief Gary Wang, and former FTX engineering director Nishad Singh. The new lawsuit alleges that the former execs fraudulently transferred money to themselves and used the crypto company's assets to pay for luxury homes, political donations, and several investments. One way the attorneys for the bankrupt exchange says SBF stole money was through a $10 million gift to his father. The lawsuit alleges that much of that gift was routed from FTX to Bankman-Fried's Morgan Stanley and TD Ameritrade accounts around January 2022. The complaint goes on to say that those proceeds are now allegedly paying for his criminal defense bills. A representative for Bankman-Fried declined to comment to CNBC about the allegations. Earlier this year, the former CEO of FTX pleaded not guilty to federal charges, and his trial is expected to begin in October. Next, a group led by blockchain investors Matthew Rozak and Peter Vicenis are nearing a $125 million deal for CoinDesk. That's according to the Wall Street Journal, which cited people familiar with the matter. The crypto-focused media company is currently owned by crypto conglomerate Digital Currency Group, which bought CoinDesk in 2016. Any sale would boost DCG's financial strength as the company looks to pull its Genesis unit out of bankruptcy. DCG declined to comment, and we also reached out to Rozak and Vicenis, but didn't hear back right away. Last, House Republicans introduced a new digital asset oversight bill that aims to create a regulatory framework to protect crypto investors. Republican Representatives Glenn Thompson, French Hill, and Dusty Johnson introduced the Financial Innovation and Technology for the 21st Century Act yesterday. The bill was first drafted in early June and tried to create a regulatory path for crypto exchanges to register with the SEC. In a statement, Johnson noted that the bill gives the SEC and CFTC a seat at the table. Thompson, who is the chair of the House Committee on Agriculture, pointed out that over the past several months, feedback from stakeholders and market participants was gathered and incorporated into the legislative product that, quote, aims to close existing authority gaps. This is the latest legislation announced amid a wave of aggressive enforcement actions, which has prompted some crypto businesses to consider leaving the US, and alongside crypto regulation bills out of the Senate, like from Senators Lummis and Gillibrand. All right, on to our main story. Despite the regulatory uncertainty for the crypto industry in the US, big banks are charging ahead with their own vision for blockchain technology, tokenizing real-world assets and putting Wall Street on-chain. Banking giants like JP Morgan, Goldman Sachs, and Citi have spent millions on the idea, and they're hoping it could be a multi-trillion-dollar industry by the end of the decade. Crypto World's Tanay McKeel walks us through the benefits and the challenges.
This is the New York Stock Exchange, where investors make upwards of 1 billion trades in a single day. Many of those trades happen in a matter of milliseconds, except not really. Trades on Wall Street actually take days to settle, and lots of people to make them happen.
Take market makers, for instance. They're the middlemen handling all those trades on Wall Street, and the top 5 market makers handle nearly 30% of all trades.
The truth is, these intermediaries help with volatility, but they also create a gap between buyers and sellers in markets. And there are a lot of gaps throughout the financial system. Ever noticed how long some bank transfers take?
If you think about infrastructure, and I mean large-scale financial infrastructure, globally or nationally or whatever, it is actually a highly siloed infrastructure, generally speaking. So money moves on one set of rails, assets move on a different set of rails, et cetera, et cetera.
Banking titans like JP Morgan, Citi, and Goldman Sachs think they have a solution. They want to push the American financial system into the next generation, and they need to borrow a tool from crypto, blockchains, on which they would tokenize various assets.
Digital first economy that we're moving towards is really important. And as our clients embark on this digital journey, being able to move money 24/7, 365 in a programmable fashion with always on is what we really want to enable our clients.
Analysts at Citi actually think tokenization using blockchains could become a $5 trillion industry by 2030.
Let's be clear, tokenizing isn't exactly new.
Well, we've been tokenizing assets in the financial markets for literally hundreds of years. When you think about a traditional stock certificate, is nothing more than a token that represents ownership of a piece of a company. This old asset was a bearer asset. If you wanted to transfer it to somebody, you would sign it on the back, hand it to them, and then they were considered to be the owner.
Electronic trading and modern payment processors have accelerated the global financial system to move assets much faster. But Wall Street still operates on what's called T+2, or trade plus 2 days. That's how long it takes for assets and cash to change hands. Part of the slowness is due to just how many steps and people are involved. On Wall Street, for instance, brokers help set up a transaction and they can charge a commission. Then market makers connect brokers to the assets they're trying to buy or sell. They charge a fee too on the difference, or spread, of the asking price of an asset and what someone is willing to pay. Oh, and huge transactions will need to go through even more steps for security and fraud prevention. Some big banks are hoping tokenization on blockchains can streamline the process of trading assets and maybe make it cheaper. To get how tokenization works, we need to talk a little bit about ownership in the digital era. Right now, it's hard to transfer ownership of real-world items over the web. Sure, you might, say, buy a car through an online marketplace, but the title that proves you own it will come as a piece of paper in the mail a few weeks later. In the hopes of bringing ownership online, developers are creating tokens that represent real-world items.
The great thing is we can do this with almost any kind of an asset. It could be a traditional stock or bond. It could represent ownership of a building. It could represent ownership of a car. It can represent ownership of virtual property in some game land.
The banks backing this technology think it could expedite trading across Wall Street and maybe create new investments altogether. That's why they're putting their money behind it. For example, JP Morgan has Onyx, a blockchain platform it launched in 2020. In the short time since then, it's handled $700 billion in short-term loans through its private blockchain. JP Morgan says it's a killer app for the future of finance.
So we have a platform called Onyx Digital Assets, which is, you can almost think of it as a general purpose tokenization platform with money that's provided through our money solution, which is called JPM Coin. And now, because you can tokenize the security and you have the money on the same infrastructure, you can potentially do a transaction for 15 minutes or 20 minutes or 2 hours.
And Larry Fink, the CEO of investment giant BlackRock, called digital assets innovation in tokenization the next generation for markets. But even with all that promise, how realistic is it that this will actually get implemented?
So you're definitely seeing a lot more experimentation. What we're seeing as a result is it's a gradual movement forward. This is not going to happen in a year. It's not going to happen in 3. It's going to take some time, and I think it's going to be a lot of it's going to be baby steps.
If banks and asset managers want to participate in the modernization of financial markets, they'll have to adopt blockchain and tokenization, according to Bernstein. In a report from June 2023, the firm said it sees $5 trillion of real-world financial assets being tokenized on blockchains over the next 5 years. Attempts to deploy blockchain tech in traditional financial markets have been bumpy. The industry tried to use it for tokenization back in 2015 and 2016, but the hype faded. The financial system is one of the most regulated industries in the world, and making changes is slow going. Multiple agencies like the SEC and the Treasury would have to get involved, and big bureaucratic government agencies are slow to change. In the SEC's case, officials there are super skeptical of crypto and blockchain technology after the collapse of crypto businesses in 2022. They just sued Coinbase and Binance, 2 of the largest crypto exchanges in the world. The agency is also considering alternatives to speeding up Wall Street. It just approved a transition to T+1, which would settle transactions faster. That new rule would go into effect in 2024. There are obstacles overseas as well. The Australian Stock Exchange actually gave up on its plan to use blockchain for its infrastructure after a study found its test program needed an overhaul. Regulators there decided it just wasn't worth it.
ASX said, hey, we're going to do all our post-trade processing on blockchain. And they went through a very large, very expensive process to re-engineer what happens after a trade. If you understand the plumbing of how markets work, it's pretty complicated for how the ownership interest of the buyer gets transferred to the seller and the money gets from the seller to the buyer. There are plenty of people who are keeping separate databases about that transaction. And that's sort of a natural area where blockchain, has potential. But even ASX said only 10 or 15% of that particular project was blockchain, but the project was an utter failure.
With that in mind, the New York Stock Exchange might be one of the last places to implement this technology.
If you're trying to apply blockchain to a very high-performing asset class, so think about equity trading. Equities trading is extremely high volume, very low latency. It's a very efficient market. I'm not really sure that you can replace some of that infrastructure with blockchain and get a gain out of it. Or on the other side, you can think of some really, really complex classes like syndicated loans, which are extremely complex and tons of people have to sign off, lots of people have to agree. That may be too tough to solve with the blockchain. I fully agree. I think blockchain solves a subset of the problems, and the rest of the problems either can be solved better through a centralized infrastructure or through some other means or a consortia or something like that. But it is definitely not a cure-all.
What will really determine if tokenization on blockchains take off is if people and businesses see a benefit and maybe don't even know they're using blockchain at all.
Okay, that's all for Crypto World this week, but we'll be back again on Monday, and we'll see you then.